Ever wonder how investors make money, whether markets go up, down, or even sideways? Welcome to the fascinating world of options trading. My name is Frank Sarjugian, and in this video, I will break down the basics of the options market, what it is, how it works, and why it's such a powerful tool for investors of all levels. Imagine you are running this small business and you have a chance to lock in the price of the raw material today. Even if the price skyrockets next month, you would be protected yourself from rising costs, right? That's essentially what the options market allows investors to do. Lock in the price, manage the risk, and even capitalize on the market movements without owning the actual asset. In this video, I will introduce you to the basics of the options trading, showing you how professional and the everyday investors alike use this powerful tool to make smarter financial decisions. Let's look at the real-world business scenario to understand option. Imagine the coffee company like Starbucks needs to buy coffee beans to keep their stores running. They are worried that the price of the coffee beans might rise in the upcoming month due to the bad weather or supply chain issues. To protect themselves, Starbucks can enter into the contract that lock in the today's price for the coffee beans, but with the flexibility. They are not obligated to buy if the price drops. This contract is like a call option. Starbucks pays a small fee called a premium for the right but not obligation to buy a coffee beans at the today's price in the future. If prices go up, they are safe. They can buy at the lower price. If prices go down, they can let the contract expire and buy beans at the cheaper market rate. Either way, the company limits its risk and keeps its options open. In the financial world, investors use options in the similar way to manage risk, protect their portfolios, or speculate on the price movements in the stock, commodities, or even entire markets. It's all about having control and flexibility. So, why should you care about the option? Let me show you with some fun example. First, insurance for your investment. Imagine you own the smartphone worth $1,000. You are worried you might drop it. So, you buy an insurance policy for $50. If you drop the phone, the insurance pays for the replacement. If you don't drop it, you lost the $50 premium. But hey, you had a peace of mind, right? Option can work the same way for stock. You buy a put options to protect your stocks from losing value. If the stock price falls, the option compensates you for your loss. If the price doesn't fall, you only lost the cost of the option. Either way, you are covered. Let's say you own a house with a beautiful front yard and your neighbor really loves gardening. They ask if they can rent your yard for a small fee to grow vegetables, but only if they decided to use it. You agree, take the fee upfront, and let them decide later. If they don't use it, you still keep the fee and your yard remains yours. In the options market, this is like selling a call option. Imagine you own the share of a stable company like Microsoft. Instead of just holding onto them, you sell a call option. An investor pays you a fee, called a premium, for the right to buy your shares at the set price with a certain time. If they don't buy, you keep the premium and your shares. Imagine you have heard about the luxury watch that might become super popular soon. The watch currently sells for 10 grand, but you think its value could jump to 15 grand in a few months due to the high demand. Instead of buying the watch outright, which would cost you 10 grand, you pay a jewelry 500 to hold it for you at today's price for 3 months. If it If the watch value rises to 15 grand, you can buy it at 10 grand and sell it for 5 grand profit, minus the 500 fee, of course, that you paid for it. If the watch's value doesn't go up or even drops, you simply walk away. Your total loss is just 500 you paid for the option, not the full price of the watch. In the options market, this is like buying a call option. You are speculating that the stock price will rise. But instead of buying the stock outright, you pay a small premium for the right to buy it at a set price. If the stock price soars, your profit can be huge, right? If it doesn't, your loss is limited to the premium you paid, much less than the cost of buying the stock outright. Okay, now let's see how options work step by step with another fun example. Imagine this. You think ice cream prices are about to rise because summer is around the corner. Right now, a tube of the ice cream costs $5, but you think it will go up to $7 next month. You make a deal with the shop owner. You will pay them $1 today for the options to buy ice cream at $5 anytime in the next month. If the price rises to $7, you are happy, right? You use your option, buy it at $5 and save $2 per tube. But what if the price doesn't go up? Maybe it stays at $5 or even drop to $4. In that case, you don't use your option and you only lose $1 premium you pay. No big deal, right? That's how the call option works. Low upfront cost with a big potential upside. On the flip side, let's say you own the lemonade stand and you're worried lemonade price might rise. You pay your supplier a fee to lock in the today's price for the next month. If prices rise, you are protected. If they don't, you just lost a small fee. That's how the put option works. Insurance for your investment. Alright, let's bring this to the life with more real-world example. First, protecting your stocks or hedging. Imagine you own the shares in the tech company and big product launch is coming up. If it's a hit, the stock price could soar. But if it's a flop, the stock could crash, right? You buy a put options to protect your investment. If the stock falls, the put options offsets your loss. If the stock rises, you enjoy the gain. Second, making money while waiting or passive income. Let's say you own the shares of the steady company like Coca-Cola. You don't think the stock price will move much in the short term. So you sell a call option, someone pays you a premium for the chance to buy your share. If the stock doesn't move, you keep the premium and your share. It's like earning rent on your stock. Third, taking a smart risk or a speculation. Suppose you heard that the hot new electric car company is about to announce a breakthrough. You want to invest, but buying the stock outright is too expensive. Instead, you buy a call option for the fraction of the price. If the stock jumps, you make a huge profit. If it doesn't, you only lost the small premium you paid. I know, option can seem tricky at first, but here are 3 tips to make it easy. First, start small and simple. Begin with the basic strategy like buying call options or protected puts. They are quite straightforward and great for learning the ropes. Second, practice before you trade. Most brokers offer virtual accounts where you can practice trading with fake money. It's like training wheels for your investing journey. Third, focus on learning. Remember, no one becomes a pro overnight. Take your time, ask questions, and keep learning. Every expert was a beginner once. Thanks for sticking with me. If you enjoyed this beginner's guide to the options market, that like button and subscribe for more fun, easy to understand investing content. Hey, drop a comment below to let me know which part of the options trading you want me to dive into next. Remember, options trading isn't just for Wall Street pros. It's a powerful tool anyone can learn. See you in the next video.